All right, we talked a lot of stocks. Now let's put it together from the macro side because we've got a decent rally underway this morning. Joining us is Tom Essaye. He's the founder of the Sevens Report, regular on the network, but it's been a while to have you on MTL, Tom, so good to have you back. Let's talk some big picture stuff, and then I want to get into oil in specific. Right now, you've got equities up. Rumors of trade deal, all that stuff, you know, some progress may be happening. What to you, Tom, do you think is kind of driving the sentiment in a market that has not broken down despite that big sell-off last week?
Yeah, I think hope, to be honest. And Oliver, thank you very much for having me back on. It's always great to be on with you. I think hope. I think it's the end of month. I think it's very low volumes. I think that, you know, my days on the buy side, you used to try and make, you know, we used to call it painting the tape. You used to try and make things a bit better during a bad month. I think we're seeing some of that. But I also think people are holding out hope that there is going to be a trade deal, despite the fact that things have gotten progressively worse now for 18 months. I mean, this thing started 18 months ago. We're still at the lowest point right now. So I think it's hope.
All right, so Tom, when will we find out if the hope really turns into something real? I mean, you know what's funny is I didn't hear a lot this earnings season about guidance. I heard a lot about the beat on the trailing, and that was nice because we were expecting a negative number and we didn't get it. But I still see earnings in decline for their expectations next year, and I wonder what that means if it doesn't turn around.
Yeah, I think that you hit the nail on the head. I think earnings is sort of the underappreciated factor in this market. I mean, keep in mind, when we started this year, Oliver, everybody expected the S&P 500 to earn $185 a share cumulatively in 2020. Now we're at 178. We're probably going to go to 175. So earnings are falling. I'm not sure when that really catches the market's attention. Probably, as you said, when people realize that the guidance isn't going to get better. We need stability in trade because the longer this sort of volatility keeps going, it's just going to cause business managers to continue to rein in. Yeah. And that's just what that's showing up in the earnings.
Yeah. So, Tom, with numbers this morning from GDP, a narrative that the U.S. is going to get dragged with the rest of the world and Powell needs to save us from that drag, yet we're still getting 4.7% consumer spend in that GDP. Tomorrow we get inflation. Given what we heard from Jay Powell last week, doesn't seem like he's exactly eager to cut. We know Bill Dudley is not eager to cut by any means now. So how do we interpret the data?
You know, I think the data is okay. If we look at the, so this is all about where's your reference point, right? If we look at the data now, it's fine. It's actually pretty good. The problem is that people are extrapolating out all this trade uncertainty that it's going to cause an issue. They're looking at the yield curve and they're saying, hey, in 12 to 18 months, we're going to have an economic slowdown. Here's the indicator for everybody to watch: jobless claims. This economy will be fine as long as employment stays where it is. It may not grow at 3 or 4%, but we're not going to go into recession either. If you see weekless jobless claims start to move decently above 250,000, that's probably a pretty good sign the economy is starting to roll over.
Okay, let's talk oil, because I thought this was another bit of a thorn in the slowing narrative side, Tom, because we've gotten a lot of draws over the last couple months, a few builds, but it came back to a draw this week in a big way. We did have some oil response, but not exactly zooming to the upside. Why?
You know, it's that macro overhang, right? I mean, people are very concerned. Again, and they're concerned about future demand, Oliver, but if I had to press somebody and say, well, what specific number are you looking at that really makes you nervous about future demand? They probably couldn't give me one. They're just extrapolating out all this trade uncertainty. You're right, from a supply side, things have actually gotten a bit more bullish for oil, but it's this demand overhang. The market is operating on the idea that all of this trade uncertainty will eventually lead to a recession. That's not a foregone conclusion. I mean, it's certainly a valid theory and something we should be aware of, but it's not a definite.
Does that mean that if the market has overestimated incoming slowness, that crude might have more upside than stocks, which are only a couple percent below their highs?
Yeah, I think so. I think if all of a sudden you see some economic stabilization, there's a lot more that crude could run, especially if you consider that the Middle East is still essentially a powder keg. And there's no real progress on geopolitical issues. Stocks, even if we go back to the best case scenario, which was Fed really dovish, trade truce, and stable growth, we're only like, 4% from 3,000 in the S&P 500, which puts the market at a very high valuation statistically and historically speaking. So I agree. I think there is more room to run on the upside there if we get stabilization in the global economy. Big if.
All right, Tom, before we let you go here, what in your way would be the best way for someone to express a better than consensus view on the economy? How do you do it? Do you short bonds, or do you say, you know what, there's still too much just money chasing yield even if the economy is all right? Do you short bonds? Do you go to stocks and say, well, they're pricing in too many cuts? I mean, do you just long oil? What makes sense to you?
It's going to sound a little odd, but I think real estate, REITs and real estate. Now, I get that they're a defensive sector, but they have high yield and housing prices are still stable. Remember, we've got mortgage rates crashing down. We have really good employment. We have rising wages. That should be positive for the housing market. This is not 2008. This is not 2007. We're a totally different animal. Everybody thinks housing gets wrapped up in an economic slowdown. Historically, it actually doesn't that much. So I think real estate's a conservative way to play a continued economy that may not grow like gangbusters, but is still growing.